You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Hi again, Don here. I need you to bear with me today because I am going to embark on an episode of debunkery. I'm really going to get into an in-depth analysis of a new exchange-traded fund that a listener brought to our attention. And, wow, if this fund could do what it claims to do, it would be almost magical. And I'm very skeptical of almost magical. You know that, right? Well, the fund is called the Strategy Shares NASDAQ 7 HANDL Handle Index ETF. What is that, you ask? Well, a couple of pseudo-academics created a study that they claim shows that you could create a diversified portfolio of stocks and bonds and practically, you gotta use wiggle words in here, practically guarantee a 7% fixed annual distribution rate from your portfolio. Doesn't that sound loverly? Wouldn't it be lovely? But we have an environment in which interest rates are really, really low. Really low. And the stock market, it has the potential to do 7 or 8 or 9 or even 10% per year, potentially. But it's going to do it with a lot of scariness and volatility that most people can't handle. Playing off the name. So what I did was I looked at the actual fund because the theory be damned. You know, they were looking backward, and backward doesn't really tell you what the future is going to hold, particularly when you're looking at historic bond yields in a period where bonds have been steadily rising for decades because interest rates have been steadily falling. We're at a problematic point for bonds, which is why we don't want you to look at bonds as a place to make money. It's a place to protect money. I don't expect that your total return going forward for bonds is going to be much better than 1 or 2% total return from high quality intermediate term bonds. That's because interest rates are low, and I did the numbers. If you have a 10-year Treasury that's yielding 1.5%, or a 10-year bond of any kind that's yielding 1.5% right now, and over that period of time interest rates go to 0, well, you get your 1%, and you're going to get about an additional 1% from the effect of falling interest rates. That's all over 10 years. That's it. 1, maybe 1.5. So I am going to go through these guys' portfolio with you. The ticker symbol for this ETF is HNDL, and I pulled it up on Morningstar. I'm going to pull it up again because I have their explainer sheet up now. HNDL on Morningstar. And we start with the very, very scary expense ratio because this is an actively managed ETF. They're trying to... They claim they're using the efficient market theory, but they're really not if they're actively managing the thing. So they charge, their fee is 1.35, but they're waiving some of their fees, so they're only charging 1.2% per year. For an ETF, that's outrageous. And this ETF is an ETF of ETFs. Their portfolio, as of the beginning of June, consisted of the Schwab U.S. Aggregate Bond ETF, pretty high-quality bond fund. Vanguard Total Bond Market ETF, pretty good bond fund. The SPDR Portfolio Aggregate Bond Fund, pretty good bond fund. Vanguard Intermediate Term Corporate Bond Fund, pretty good bond fund. And the Hartford Total Return Bond, which is a little riskier, a little slightly higher yield. Some municipal bond funds, preferred ETFs, and some stock funds. So, where does that take us? Well, I went through the portfolio, and as of the 1st of June, 21% of the portfolio, almost 21%, is in stocks because they're going for the higher return of the stock market. So we're gonna write that down, 21% in stocks. Fixed income, that's the bond portion of the portfolio, is about 57% in bonds. Okay, got that. And then they have over 15% in cash. Wait. Why would they do that? Well, I guess, one, it guarantees that no matter what happens for a couple of years, they can pay out that 7% return they promised, because that's right now what the return is. The 12-month yield is 7% for this fund, 7.04. But let's go back to the portfolio for a minute, because I went through every ETF in the portfolio. And of that 57% that's in bonds, this is very important, the average taxable equivalent yield is right around 1.5% a year. Okay, so the fund yields 1.5% a year. It's unlikely it's going to yield a lot more than that going forward unless interest rates go up, which will cause the bonds to go down. So let's just say 1.5. Let's see, the 16% in cash, that earns 0. So we're still at 57, 70 some odd percent of the portfolio. That, 73% of the portfolio, yielding now an average of 1.1% when you throw the cash in, 1.1%. Now, how about stocks? Well, with 20% of the portfolio, 21% in stocks, let's say you earn 10% per year on average. You're doing very well with your stock portion. So what's that average out to with just 20% in the portfolio? That's 2%. So we have 2% plus 1.1%. That is a net, or a gross actually, of 3.1% per year. Okay, let's say interest rates go to 0 and they hold all those bonds. So that means maybe they can add another 1% to that. And that's assuming stocks go up 10% per year. So now we're at 4.1%. Oh, wait, but we've got to deduct their fees of 1.2% per year. And that brings us down to 2.9% per year. Does anybody see the problem with a 7% guaranteed payout? Where's the other 4% coming from? Out of your principal. That's how annuities work. Basically, this is no different than an annuity that is going to draw down, on average, about 4% of your principal every year. It's going to be a self-liquidating asset. No two ways around it. There's no way around it. It's impossible. It's impossible for this thing to yield that 7%. This is the game of sleight of hand that so many play when they say, oh, yeah, I can get you a 7% return on your money. Insurance companies used to say this. They don't say it much anymore because they know the reality is much lower than that going forward for now. But these guys are doing it, and I think it's massively disingenuous. It is a sales pitch and nothing but a sales pitch. It is horribly misleading. And if you read their prospectus and their disclosure documents, you'll find that they say, oh, we really can't guarantee we're going to do any of this. And the risk can be really, really high. And the costs are really, really high. 1.2% for an ETF, high. This fund group manages another fund that I looked up, the actively managed fund. I would avoid anything from this company. Its ticker is ROMO. Get this name. Strategy Shares Newfound Resolve Robust Momentum ETF. That is a heck of a mouthful. And if you look up Romo, you'll find it hasn't been around for very long. In fact, it's just started the end of last year. And it had a little growth spurt at the end of 2019. Now, they're supposed to be trying to time the market. Well, they're really trying to hedge the market and try to be in when it's going to go up and be down when it's going to go down and all that kind of neato-kino stuff that everybody claims they can do. This fund has, year-to-date, lost 17.5%. It's a very complicated portfolio of ETFs with an expense ratio that can go as high as 1.35, although they're eating some of that right now and only charging 0.87% or 90 basis points. That's still a lot. And if they're trying to hedge the market, for good times and bad, that kind of thing, well, I thought maybe let's compare year to date with a 60-40 portfolio, 60% in the Vanguard Total World Stock Index and 40% in the Vanguard Total Bond Market Index. Year to date, those two funds combined in a nice hedging strategy. You own stocks and bonds. You don't actively manage it. You just kind of own them both, and you pay very, very, very little for it. If you had those two, your year-to-date return for that combination, 60-40, would have been a negative 2.2%, or about a negative 15% better. And you did it without anything complicated or expensive. This is why I am so reluctant to suggest anything fancy, anything complicated, because investing is not supposed to be complicated. It's not supposed to be expensive. The only people who win when it's complicated and expensive are people like the people who created these funds, not you. Steer clear. Keep it simple. Keep listening to us. Oh, and by the way, if you'd like to attend a class next week on avoiding bad brokers, we're doing it on June 10th at, 11 a.m. Eastern. And if you're listening, and this is, you're listening after June 10th, well, check. There may be something else there. Go to talkingrealmoney.com/ or just go to the event button and check it out. Also, and I'm reminding everyone that you can get my book, which is all about simplifying investing. Some people have said it's too simplistic. Yeah, it's too simplistic because investing is simple. What they're proposing and they're presenting is not. It's complicated and it's not really investing. It's called Financial Physics. I rewrote it in 2018. There is a really cool interactive version available for free at Apple Books, the Apple Bookstore, for those of you with Apple devices. And if you don't have an Apple device, you can go get a PDF at talkingrealmoney.com/free, talkingrealmoney.com/free. Let's see, is there anything else I need to tell you? No, but please steer clear of anything that makes an outrageous promise. If anybody anywhere says they can get you a return that's higher than what you know you can get safely, 1.5%, 2%, then you must know there's some sort of risk involved. And if they claim there is none, then I guarantee you they are lying. And remember, people lie. Even the ones that seem oh so nice, they lie. And these guys, I think when it comes right down to it, they're basically telling a lie based on past performance. But the future can't support that, as I think I showed you. Thanks for being there. Also, by the way, I forgot, send your questions in. Love to answer your questions. We'll get a bunch of them on Friday's podcast, the weekend podcast. So you can call them in to 855-935-TALK and just leave a message with your question, as much detail as you want to leave, or type it in at talkingrealmoney.com, click the contact form and send that to me. And Friday will be mostly questions. A little bit of something else, but mostly questions. 855-935-TALK or talkingrealmoney.com, the contact form. And thanks for listening. Thanks very much. I really appreciate you being there. I'm Don McDonald.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.